Welcome to a bonus edition of the Daybreak Asia podcast. I'm Doug Krisner. The Chinese government is set to unleash its strongest wave of economic stimulus in years, based on the signals from the latest Politburo meeting. For a closer look, I'm joined by Stephanie Leung. She is the Chief Investment Officer at StashAway. Stephanie joins us from our studios in Hong Kong. It's always a pleasure, Stephanie. Thanks for making time for us. You and I were talking a moment ago about these stimulus measures. It seems clearly the government is intent on doing a lot more. So I'd like your assessment on what you've heard so far from the Politburo and whether, in your view, this is going to be enough to kind of restore confidence and move the needle in a major way.
Yeah, so I think if we look at the China situation, of course, earlier in the year, there was a lot of concern that the housing slump would actually spread out to a much more wider spread kind of systemic risk. There were also a lot of people calling China uninvestable. And then, the Chinese government came out with, a slew of forceful announcements. That sort of restored, confidence a little bit, but more importantly, it kind of pushes up asset prices, force out a lot of short sellers, and now that investors are actually kind of, have been asking a different question. Like, instead of whether China is kind of uninvestable or investable, now I think investors is asking a different question of, where is the China stimulus going to be, and is that going to lift economic growth going to next year? I think going into this week, there has not been a lot of kind of high hopes that China will actually come out with, the concrete measures. This is not traditionally the venue for them to announce some of these concrete measures. Even, for example, the fiscal budget would traditionally not be announced in December, but instead, a lot of these measures would be kind of hashed out in March. So I think the market obviously rallied on day one that these announcements were made, but gave back quite a bit of gains as well on the second day. I think if we kind of look at the announcements that come out this week, I think the key takeaway is that, number one, the government seems to be quite resolute in terms of the will to continue to be supportive of the economy. Indeed, if you look at their language, for the first time in the past few years, they've actually replaced some of the more restrictive language with words like prudently manage monetary policy and stimulus policies, and I think that gives the market some excitement. For us, I think the most important word, if we have to choose from sort of the announcement, is the mention of consumption-led stimulus. Because I think in sort of traditionally, or kind of from a Xi policy toolbox perspective, he has been kind of more proactive in terms of supply side stimulus, and he's not a particular fan of the demand side stimulus. I think this announcement that just came out shows that at least he is kind of making a turn in the way he views the role of these kind of demand side and consumption stimulus. And I think that gives us some hope that they will come up with more concrete measures in March. In our view, I think that's sort of what China needs right now. China is not short of money. Indeed, there's a lot of liquidity. The problem is that there is a lack of confidence from both a consumer level and an investment level to actually put these money to work. And I think that would trigger, if these money would be put to work, and of course to be put to more productive work, then that could trigger the next wave of earnings upgrades.
So I'm curious as to whether or not it encourages you to make investments on the mainland. Is there enough going on here to pique your interest?
So from our investment framework, we track a lot of real-time economic data to guide our decisions. And if we look at the China data, for example, PMI has actually been below 50 for quite a few months. Recently it's turned higher. So the November PMI reads actually 50.6, which is expansionary. And we need to see a few months of sort of the data turning into more expansionary before we would take a more aggressive stance. So far this year we've maintained a market weight stance on China on the basis of, number one, yes, the earnings has been kind of sluggish, but at the same time valuations have been very, very low. And if we look at valuation perspective, today, I mean, MSCI China is trading at around 10.5 times. This is sort of 10% below historical average, so we have a bit of room to run up in terms of valuation. But I think still the key is whether we see a sustainable earnings growth trajectory. And I think a lot of the numbers and the data that we look at suggest that, yes, I mean, we have seen the bottom, but for a sustainable rally to start, I mean, we are not yet there. So we need some more forceful policy that could trigger a bit more animal spirits, that could trigger some of these data to turn even stronger.
So as long as we're talking about data points, the other day we learned that exports in the month of November, I think, were up at a rate of around 6.7%. Many companies, we were told, were rushing to get goods to market in the U.S. before new tariffs were to take effect, if in fact that happens. 6.7, though, was a little bit below the estimate. And I think you and I can agree that one of the bright spots for the mainland economy has been export-driven industries. What does this cause you to do when you get a data point like that? You consider the risk of tariffs and maybe a little bit of increased tension between the U.S. and China. Do you put money to work in some of those names that are more export-driven, or do you kind of avoid them at all cost?
Yeah, I think if we think about the export sector, it's actually in a structurally sort of difficult position. I'll say it from a few points of views. Number one is, of course, there will be some announcement from the Trump administration on tariffs. Now, we don't know whether or not they will be substantial. I think, at least from a rhetoric side of view, Trump will, the Trump administration will make it quite pronounced, and that could have some dampening effect on the sentiment and also on kind of both from an investor side and also from kind of a real trade industry participant perspective. Secondly, I think if you think about kind of take Trump out of the picture, but think about kind of the bigger trend of the globalization. That has been happening, I guess, since COVID, and I think this is a structural trend that is very, very hard to reverse. And it's a very, very popular opinion in both U.S. and China that both economies or both countries need to kind of build their own ecosystems and have kind of much more domestically supported economy. And I think this is what the U.S. and also Chinese governments are aware of as well. That's why, I mean, you see that Trump policy has a platform of bringing everything sort of onshore again. U.S. manufacturing is going to be one big focus of his presidency, and also from a China perspective, of course, the government also talks a lot about domestic consumption. And really, I think domestic consumption is the key to a kind of revival of the Chinese economic engine. Because if you think about the traditional growth engine of China that has been export, has been property, has been sort of technology from a kind of internet growth point of view. Now, if we think about these three engines, property will not revert back to where it used to be. Internet, arguably, it's something that the Chinese government can actually re-trigger a somewhat a growth. But I think from the export side, it's also quite cyclical, and it's hard to kind of form a structural positive view given the decoupling that we're seeing globally. So I think, really stimulating consumption, stimulating kind of internet technology advancement is the main policy goal that policymakers could pursue.
One of the things that the Biden administration was successful in doing, putting these export controls in on certain high technology components, particularly related to semiconductors. Now, I know that you have a strong background in computer technology. Give me a sense of where you see China right now in the evolution of its tech industry.
Yeah, if you kind of look at, China technology is actually quite broad, right? If we talk about AI, for example, I think China's AI technology has been lagging behind the U.S. and given all these kind of, restrictions on imports, it puts China 2 to 3 years sort of behind the U.S. And there is some belief in Silicon Valley that if U.S. is able to achieve AGI, that could actually put the U.S. years ahead of China, just from a leapfrogging. from that perspective, I think the U.S. is definitely trying is very best to try to kind of prevent China from advancing too quickly. But from other perspective, for example, China is actually more on the cutting edge. In terms of drone technology, for example, actually China has a very, very leading edge advantage in drones, and that's partly because of the research efforts that's going on in China, but partly because of regulations in the U.S. So I think perhaps what the Trump administration would try to do is to remove some of these red tapes and remove some of these kind of regulations in order to make sure that, U.S. really do not actually fall behind China in key kind of strategic technology areas.
Stephanie, we'll leave it there. It's always a pleasure. Thank you so much for making time to chat with us. She is Stephanie Leung, the Chief Investment Officer at StashAway, joining us from Hong Kong here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.